Hey guys, Brian Stevens here with Mortgage Shots and the Loan Factory. You guys really need to be a part of this trend because we are doing things differently. Fill out the information down below and give me a call. Now, the Federal Reserve, well, they're not doing a thing this week. Rates aren't going down, they're not going up. Now, the thought processing must be that everything is going so swimmingly that the Fed fund rate needs to remain the same. Cue the video.
Here's the thing. Credit card debt is at its highest level, and the average rate people are paying is north of 20%. If you want to go after one group for usury, it's the credit card companies. If you're under 30 and you have credit cards, quit using them immediately. If you Uber Eat and put that pastrami sandwich on layaway, stop. You're going to find yourself in a mess that is veritably impossible to get out from under. If you ever want to buy a house, stop with unsecured credit cards right now. It's just that simple.
So here's the real kicker in this whole thing. Commercial credit card delinquencies, as you can see from this graph, are through the roof, higher than any time during the Great Recession. Mark our words on this one. Commercial, not residential loans, are going to ultimately be our undoing. But back to the job at hand.
Since 15 and 30-year mortgages are largely tied to the Treasury yields and the economy, those rates haven't moved much, and that hasn't helped would-be buyers. The average rate for a 30-year fixed mortgage has stayed within the same narrow range for months and is currently near 6.9% according to Bankrate.
Which, by the way, with us, is paying us north of 2% back on lender-funded deals at Loan Factory. So if you want to learn more, again, just fill out the box down below. Now moving on. Anyways, tack on the nationwide problem of limited inventory and housing affordability remains a key issue regardless of the Fed's next move. Quote, I don't see any major changes coming in the immediate future, meaning that those shopping for a home this summer should expect rates to remain relatively high. And this is according to Schultz.
So rates. If that's your game, get out of it. Talk payment, not rate, and you'll do better. So who's your client? How about this? A balding middle-aged man who still thinks Pearl Jam is relevant.
Anyways, the average first-time homebuyer is pushing 40 years of age. Yes, 40 years. It's unbelievable, yet here we are. Now, of course, this speaks to unaffordability and rates that should be lower, but here we are.
Quote, it's likely going to be just as difficult to buy next year as it is this year. This is according to Redfin's top economists, with steep prices and mortgage rates keeping young buyers on the sidelines.
The youngest U.S. home buyers aren't so young anymore, as a foreboding market turns first-time home hunters into an activity to people nearing 40 years of age. Quote, no one in their young 20s are buying homes. And this is according to Ricky Vaughn, a real estate agent in Southampton, Pennsylvania, who has noticed his clientele getting older lately. So who's your client? Well, pick up an Alice in Chains record, and you're going to find your professional answer. My friends, I hope this helps.